This program is brought to you in association with First National Bank of Botswana. First National Bank Botswana has announced yet another stunning financial performance with a 19% profit after tax for the half-year period ended 31 December 2022. The bank also announced a return on equity of 31.2% and an interim dividend per share of 12 thebe, 20% more than the same period in 2021. On the reins, leading the team to another record-shattering half-year results presentation were the bank's Chief Executive Officer Stephen Bogadzu and outgoing Chief Financial Officer Luke Woodford. Good evening and a very warm welcome to First Issues. While there's no denying that the results are impressive, there's ironically general talk, even from fellow commercial banks, that the reason First National Bank Botswana is making such astounding numbers is because of the high service charges to customers. Lest these fables are accepted as facts, thereby tarnishing the bank's credibility and trust amongst its valued existing and indeed potential clients, is the bank ready to address these perceptions so they may finally be laid to rest? Ready with the answers is the CEO, Stephen Bogadzu.
We are doing a number of studies. I think that is very good feedback from our customers. I think our fee structure is very complicated. I'd be first to acknowledge that. So we are doing a number of exercises. Number one, to determine if indeed our fees are higher than the market. We do not believe that our fees are higher than the market, but we are checking as we do continuously check with the market. So the last exercises that we conducted, we actually realized that our fees are not out of sync with what the market is offering. So we continue doing our investigations to ascertain that complaint from some of our customers. So we will share with our customers what the results of that study will indicate. That's number one. Secondly, there is a reason why when you look at the structure of our income statement, there is a big portion of fee income. And the reason why there is that big portion of fee income is as a result of our product offering. We have previously indicated one of the things that we have a focus on is on ensuring that our customer is not just offered one product, but offered a bouquet of products that make life simpler for them. So as a customer of the bank, for instance, we will offer you a personal loan, we'll offer you a property loan, we'll offer you a vehicle and asset finance loan. In addition to some of these products, we will also offer you a credit card. We will also offer you an opportunity to open an e-wallet account that enables you to pay your suppliers and other service providers and relatives and friends from the comfort of your home without the inconvenience of going into your car, incurring petrol expenses, etc. Now, if you compare our bank, for instance, with another competitor who's only offering two products, of course, the one who's offering multiple products to his customer base will be rewarded in terms of non-interest revenue as well as interest income. Whilst I appreciate the feedback that I'm getting from customers that we may be expensive, which we continuously investigate and have found out that that is not necessarily so, we will continue the investigations. But the truth of the matter is our ability to focus on what we call VSI, which is basically the number of products we offer every customer, is the reason why our fee income is the way it is. We have not had, in fact, there are some years when we have not even had a fee increase for a protracted period of time. And even when we do, I mean, some of the proposals that we are putting together now for fee increases include adjusting our fees by way below inflation. That's number one. Number two, over time, which is the reason why you are seeing only a 5% growth in our fees and commission. We have made a deliberate decision that we are actually going to reduce the burden on our customers by removing some of the fees. So we have looked at segments of our customers, both in the retail front as well as in the commercial space. We have zeroized some of the fees. We have decided to take away some of the fees. We have reduced some of the fees, not because we believed we were not competitive, but because we believe that the consumer and some of the smaller businesses are under so much stress because of economic conditions that this is what we can offer to the market to help their businesses survive these economic hardships.
Let us now talk about the economy within which you operate, right? Botswana is in a state of recovery following the pandemic. And with that also, there's a looming recession that has been forecast. So in the event that that recession becomes a reality, obviously Botswana is going to be affected. So how do you see that affecting the bank, if at all it becomes our reality?
We have a number of scenarios that we adopt as a bank. As we craft our strategy, as we craft our plans for the year, we assume different scenarios. So one of the scenarios is the scenario that you are describing, which assumes that the environment where we are operating in is going to be very difficult. So how we prepare for that is by ensuring that we have a number of measures that we'll be putting in place in order to assist our customers. I've already mentioned on the fees and commissions. We are looking at other measures such as ensuring from a liabilities perspective, we are incentivizing some of our liability providers. We are looking at measures that we are putting in place to look at our customer base and segment our customer base and determine what interventions we need to put in place in order to reduce the impact of the economic burden on some of our customers. So for us, the response is primarily around what we can do to help our customers survive the hardships that you are alluding to. Thirdly, from a credit perspective, we have said there are some restructure products that we can put in place in order to help our customers survive the difficult period by ensuring that they are able to meet their financial obligations with the bank.
As a business magazine portal, we follow business news from across the world. And what we've been seeing is small, medium and large corporates and organizations and even banks conducting mass layoffs in an attempt to, amongst other things, manage costs post the pandemic, right? So are we going to be seeing the same happening at the bank, or is the same happening at the bank?
We have followed a totally different process over the last couple of years, which is a process around assessing the impact of, number one, introduction of automation and robotics within the bank. That process has been run in parallel with a process that aligns our processes to the current way of doing business in banking. So over the last couple of years, when we started this process, the restructuring process, we have actually found that there are some areas that deal with customers that actually require increased complement as opposed to laying off. If you look at our staff numbers for the last 6 years, when we started our process re-engineering exercise, you will find that we actually had about 1,400 staff members. And 5 years later, our complement has actually increased. It has increased as a result of the following. Some of the areas that were subjected to this process re-engineering were found to be inadequately staffed. Number two, we have had regulatory developments that have necessitated the need to bring in more resources in order to cope with the requirements of regulation around KYC, around FEDCA, and around many other processes that would be required by the fears of this world. So we are following a different process that helps us determine the optimum levels of staffing in the bank. Of course, as we re-look some of the areas in an effort to improve service, we have had instances where some staff members have actually raised their hands and have said, I would rather not be part of this process. I would rather not move to this particular area. I would rather opt out. I would rather exit the bank. And based on mutual agreements with those staff members, they have exited the bank. But our number one port of call has always been what other opportunities exist in the bank so that we retool, we reskill staff members that may be affected by a process re-engineering project and move them to other areas that they have been reskilled for. So laying offs has always been, and I've said in the past that laying off staff members is the last option on the table. And I am happy that so far we have not had to exercise that option.
Welcome back to the program, where we are now engaging First National Bank Botswana's outgoing Chief Financial Officer, Luke Woodford, on the just announced half-year financial results for the period ended 31 December 2022. Luke, thank you so much for coming on First Issues and affording us your time. We are at the FNB Botswana half-year financial results for the half-year period ended 31 December 2022. So, before we go any further, please give us a brief overview of the financials.
Sure, absolutely. We've had a great set of results again. We saw a 19% growth in our profit after tax. So during the period, we had managed to extend advances to customers. There was demand coming through from all of our segments, from retail, commercial, and corporate. And the net growth in our advances portfolio was 11%. And then during the period as well, we noticed that there was increases in the prime lending rate. So the combination of those two resulted in quite a significant lift in our interest income over the period. Then when we look at our interest expense, we saw a number of our customer base fixing their deposits. I think customers were looking for an opportunity to grow their yields. They have better line of sight as to where their businesses are going, and they use the surplus funds to do fixed deposits, as well as increased rates that resulted in a 81% growth in our cost of funds, so our interest expense line. So the net impact of that, just over 20% growth in our interest revenue, our net interest revenue. Then when we look at our impairments, well contained, we sat at a credit loss ratio of only 1%, meaning that the risk in our portfolio seems to be well managed, and we've been very careful and conservative with our provisioning and with our credit origination over the past few years. Then we look at our non-interest revenue. We've seen some margin squeeze coming through in our point of sale devices. So we've put out an extra 700 point of sale devices. So we're growing that infrastructure. It is part of our core strategy of that cash to card strategy, and moving people away from using cash on a daily basis, really using a card. And just a reminder there that the cards are free. So if you swipe your card at a point of sale device to pay for your goods or services, you're not going to pay for that transaction for all the transactional banking customers. So we did see a bit of compression in the margin there. Our foreign exchange business has done very well. We saw the growth in a lot of tourism. It's rebounded extremely well, with travel coming back nicely. We've also seen that our FX on app, so there's a solution that allows us to pay, or all customers to pay funds internationally using FX on app, end-to-end on the app, and we see a nice pickup of that. And then just our core fees, they increased by 5%, so 3% growth in customer base, and then we saw that fee income increased by 5%. And then our cost base came under pressure. So we've, much like any other business in the world, have seen the inflation impact on our cost base with input costs going up. Travel is a lot more expensive. Running the bank is more expensive. The costs of electricity, the costs of the day-to-day operations. We've also used the opportunity of it being a lot safer with COVID having subsided to see our clients and to see our staff members. So we actually, it was a much more social year, in fact. So we've seen that pressure coming through in our cost base. But overall, our cost to income staying roughly 47%, well within the thresholds that we've set. And all of that culminating in a 19% profit after tax. So actually a good set of results.
The possibility of further rate increases remains open, with inflation likely to remain elevated over the short to medium term and outside the central bank's range throughout 2023. These challenges are rightly expected to exert pressure on the average consumer's spending ability, right? So how do you see that potentially affecting the bank's bottom line?
It's been a difficult year in the past for these exact same reasons. We've seen 151 basis points increase in our prime lending rate. And we've also seen that inflation has stayed high over the past year and a half. Now, as we expect that to continue as a trend going into the next year, we expect that what we've seen this year to mirror what's coming. And what we've seen is that customers, retail customers' deposits are not growing as fast as they were in the past. So retail consumers, they are earning funds and needing to spend it on day-to-day living. So the savings rate of retail customers has slowed down. So we are expecting that. We saw that the opposite was true for commercial or for businesses, where their turnovers have increased substantially, but their input costs are up. So our customers, and the reason I talk first to customers is our earnings and our function as a bank is really on the back of what customers need. So the retail customer is going to be under pressure from savings. They're also going to be under pressure where they've borrowed and they have an increased cost of servicing that debt. And very similarly for the commercial customers. So what that means for the bank is, firstly, that we see the opportunity to advance. We're not going to necessarily increase our credit risk. So we are going to be very careful with where we lend money in the next year. But we do see opportunities to lend. It's not that we've closed for business at all. And one of the key ones, we are really trying to drive home ownership. So that 105% home ownership, or that loan to value, we would call it. So the 105% bond, which covers both the cost of the house as well as some transfer duty, that's a big product for us. We want to see people own homes. And that is possible in this current environment. It's important to do it as soon as somebody's able to afford it. And we're careful with how we assess the credit on that. So we expect that we will have some constraints with advances growth, but there will be pockets of opportunities where we can partner for growth. We are expecting liquidity to open up a bit. There's some cash coming back into the country with regards to the change in the Pension Fund Act, and we are expecting the liquidity position to be stable and to improve slightly. And what that means then for the bank's earnings is we should see that our interest income line remains quite stable. It runs through peaks and troughs as the interest rate cycle moves, but we should see that we continue with some strong earnings on our interest income. Obviously, we're concerned with regards to clients being distressed, and therefore would look at our impairment line and make sure that we have enough provisions to cater for those credit losses that might come. And also for restructures. So if customers are going through financial distress, we encourage them to come to us as soon as they can. Talk to us and see if we can help with any cash flow assistance that might need to be put in place to help them to manage the medium term.
While admittedly we are discussing half-year financial results, do you think that the bank is on trajectory to achieving the earth-shattering record that it did in the full-year period for 2022, this full-year period in 2023?
we've had an excellent set of results for this period, and we aren't. We're looking at the next 6 months and we're saying what macro factors might come our way. I think we've been quite conservative in our capital and our provisioning, which, as a bank, when you have a very stable balance sheet, it allows you to do the partnering with customers that I spoke to restructure, to help. What we're trying to do, though, is build a bank that lasts the test of time. So we aren't necessarily just worried about the next 6 months. We're making sure that and this is big on what Steve has spoken to with the shared prosperity focus. They're saying, how do we build a bank that lasts the test of time, that lasts the next 25 years, 50 years? And part of that is ensuring that we are sustainably integrated into the ecosystem of Botswana. So the localization of services, it's a big focus for us. So yes, it might cost a little bit more, or there might be a bit of efficiency gap with it as we find our feet with this. But we're trying to make sure that the shared value that comes out of the bank is shared by the communities we operate within. So the next 6 months, I think, are going to be challenging. I think it's going to be challenging for us and for the communities. But at the same time, we are really in a great position to go on this journey with our customers.
This program was brought to you in association with First National Bank of Botswana.
FNB, how can we help you?